Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I get a lot of questions during the live sessions about how to start investing or how to invest a specific sum. The easiest way to go is with ETFs, exchange traded funds, passively managed, meaning they follow a formula. For example, it's at least this big, profitable for the last 2 years, etc. Or they follow an index. An index is a basket of assets created by a ratings company to have a certain set of attributes. Most well-known standard indexes are the TSX Composite, which follows the Toronto Stock Exchange, the S&P 500, which is the Standard & Poor's 500 biggest US companies. We have the NASDAQ 100, which is mostly technology companies. And we have the Dow Jones Industrial Average, which is industrial companies, whatever it means at the time. I like to go geographically. So here's an example portfolio. This doesn't mean it's right for you, but it is the one I have in my TFSA, and you can take a look at www.canadianmoneytalk.ca in my portfolio, and please do your own research and make sure what you invest in is correct for you. So we have XIC, which is the BlackRock iShares Score S&P TSX Capped Composite Index ETF, and that covers Canada. We have XUS, which is BlackRock Canada iShares Score S&P 500 Index ETF, which covers the US. We have XEF, which is iShares Score MSCI EFI IMI Index ETF. All of those letters stand for Morgan Stanley Capital International, and EFI stands for Europe, Australasia, Far East, and these are developed countries in those areas. And finally, we have VEE, which is Vanguard FTSE Emerging Markets All Cap Index ETF, and these are developing economies. Give these ETFs weightings according to your time frame. So when do you need the money back? Your risk profile. Are you able to withstand psychologically and financially a 5% drop in your portfolio? 10%? 20%? What returns do you need to meet your financial goals? Now, you should look at your financial goals prior to investing. Is it retirement? Is it early retirement? Is it work when you want to? Is it time with family? Is it travel? Is it down payment for a house? Those will all have different time frames and different types of investments that will target them. So looking at the ETFs, closer to home can be considered safer and less volatile, but it really depends on what index you follow. If you have a long time before you need the money, or if you don't mind the volatility and have at least 5 years, you should be in all stock ETFs, preferably smaller companies that have more upside. So looking at the 4 original ETFs as an example, you can do 30% in Canada and US each, and then 20% in the developed world and 20% in emerging markets. So if you have a lump sum to invest one time, you would invest the amounts according to this. This percentage has a closer to home bias, but you do have 40% outside of North America. Again, this is just an example. You have to set your own percentages, but it's not that difficult. So some modifications you can look at. You can add a bond ETF if you're conservative and don't like your portfolio to have a lot of ups and downs. But you have to acknowledge that the trade-off is less ups as well as less downs. Bonds are like a piggy bank to store money for when, not if, there's a drop in the stock market, and then you crack open the piggy bank and buy cheap stock ETFs. You could add a NASDAQ 100 ETF for technology exposure and more volatility. You can add an ETF that's following the Russell 2000 index for smaller US company exposure. And you can also go with an all-in-one ETF like VEQT, so you don't have to do anything and you have the whole world covered with stocks. Some other customizations to your portfolio would be to divide it in different ways. You could slice it up according to value and growth dimensions. So you could add a value ETF and a growth ETF. As an example, VVL for value and VGRO for growth. And I do have a video explaining the difference between growth and value. And you can use a balanced ETF, which already contains both stocks and bonds, so you don't have to buy a separate ETF for the bonds. An example of this is VBAL. Now, if you feel strongly about certain countries or sectors, you can do ETFs that cover stocks domiciled in a specific country, or an ETF that follows the energy or the tech index, for example. Although you're now getting away from the basic and simple portfolio, you're causing yourself more work, you have less diversification, and you're not really guaranteeing better performance. You could substitute, controversially, mutual funds for the ETFs. Over a longer period, very few mutual funds beat the indexes that the ETFs follow, but it's not hard to find mutual funds that beat the indexes even after fees. Although, to start simple, the ETFs don't require any monitoring. You don't need to find something that beats the benchmark because you're buying the benchmark, so you're fine forever. Once your portfolio gets to a certain size, let's say 100K, and you feel the need to try to beat the market, as represented by the index, you can learn about stock analysis and consider buying individual stocks in a core and explore portfolio, where 80% of your portfolio is the ETFs we talked about, and then you buy some stocks that you love and really believe in. Don't do this unless you enjoy stock analysis and keeping up with the economic news and your stocks news. So what are some ongoing actions and activities that you need to do to maintain your portfolio? I will do a video in a week specifically about maintaining my portfolio and what I do on a weekly basis, but here are some things to do for your simple portfolio. Most importantly, you should automate monthly additional purchases as much as you can afford sustainably, modified in amount by how quickly you want to achieve your financial goals. You have to keep investing, always be buying. The automated payments should be in the same percentage as you decided on when you were investing and creating your portfolio. So following our example, if you have $1,000 to invest per month, do 300 into each of the Canadian and US ETFs and 200 each into the developed and developing world ETFs. About once a year, at most once every 6 months, if you chose to have certain percentages of the ETFs in your portfolio, you should rebalance. So if you were looking to have 30, 30, 20, 20 into the 4 ETFs, over the course of a year, these percentages will get out of balance, so they will be different. And you may be more or less exposed to risk than you're comfortable with. This is intended, since you have different ETFs for diversification, and you don't want them to move all in the same way, in the same direction, and by the same amount. So once every 6 to 12 months, sell and buy ETFs to get back into balance. I did a video about this concept, but it is important in the performance of your portfolio because it will have you buying low and selling high as far as your portfolio is concerned. And that's all. It's not difficult. There is a little bit more to it, such as different accounts. So see a video about RRSPs versus TFSA. And you can worry about taxes as well. So because of the foreign content in 3 of the 4 ETFs, there will likely be a 15% tax withholding of the dividends coming from the 3 foreign ETFs. But the ETFs are intended for growth of the share price, and they just pay small dividends. Yes, you should research things before you do something for the next 20 years. But also there is an analysis paralysis syndrome out there where people don't start investing because they are trying to find the absolute lowest cost, the perfect ETF, or making sure they don't pay an extra 0.3% in taxes. But if that research delays their start and makes them miss out on time in the market, it's bad. Perfect is the enemy of done, as the saying goes. So that is my basic, simple portfolio. Everybody can start investing in this, and you can have as little as just one ETF, and you are in the market, and you don't have to worry about looking after things on a daily basis. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.